like a yes in the chat lah. So at least I know you all can hear and see the screen as well lah before I start. It's good to see quite a few people join. Okay, thank you very much for confirming. Okay, let's start. Okay, so welcome everyone. So my name is Sam. I'm from the Philip CFD team. And today I'll be talking about how macroeconomics can actually create opportunities, especially nowadays, right? As the macro environment has been changing quite a lot even on a daily basis, even within the day, right? It keep changing. Okay, so how does this affect you, and how you can use it to capitalize on it, and so on. Okay, first thing, some disclaimer. So of course, the information that I'm about to share, we will only for educational purposes. So this is not a call to buy or sell anything. This is just to state the facts and to discuss observations and so on. But if you want financial advice, please talk to your trading representative. Okay, so first thing, what are we going to talk about in this webinar? So first thing, we explore a little bit more about what is macroeconomics. So what is involved, what is not. There's sometimes a misconception of what is macroeconomics and what is not. There's macro, there's micro, and what's the difference? Don't worry, we'll touch on it a bit faster. So at least we get into the main stuff, which is the current macroeconomic trends. Of course, we're talking about the US and how the US macroeconomics are affecting the world, keeping up to date to what's going on over there. Then we will have a look at what we can learn from the past. So, Donald Trump and his playbook, whether he has done it before and how does it affect looking forward. That's where we come to our fourth point, looking forward. So, now that we know what's going on, uh, looking forward, what can we do? What can we expect from past history and also the things that he has said, or even the Federal Reserve have said in observations. And lastly, we also end with a promotion that we still have. So first thing, what is macroeconomics? So macroeconomics, broadly saying, measures the performance of economies. So it's like a big umbrella where it covers like a top down. So it covers the economy. So from things like interest rates, foreign exchange rates, inflation, government policies, balance of payment. Don't worry, balance of payment is something that not a lot of people know or talk about. Don't worry, but we will discuss it further later. And also any changes is economic output. So economies usually is measured in terms of gross domestic profit, or GDP for short. Usually, if you hear, like in the news, they say, GDP went up 2% and stuff. So those GDP is usually used as a proxy to the size of the economy. Then, as you can see here, I've bolded three of the stuff lah, which is interest rate, government policies, and balance of payment. These are the three things we'll be more focusing on in this webinar. Of course, given that other are still important, but within the scope of this webinar, we'll be focusing on the interest rate, government policies, and balance of payment. But don't worry, interest rate and inflation are closely linked. So first thing, interest rates. So when I say interest rates, or when macroeconomics people say interest rates, what does it mean? It's not interest rate on your your mortgage or your car loans. Interest rates are more about what the Federal Reserve said, and there's a one very beautiful quote from Warren Buffett. So it's interest rates are to assets what gravity is to the apple. When there are low interest rates, there's a very low gravitational pull on asset prices. So it means that, when interest rates are low, so the overall interest rates among the economy usually is set by the Federal Reserve or the central bank of a country. So interest rates affect the rate of borrowing. That means, let's say companies want to borrow money to expand their businesses, they will need to pay a base rate. Usually, what we quote is a prime rate or P or a benchmark rate, and generally the central banks are able to influence this benchmark rate. So let's say a company of Apple, most likely they can borrow money at very close to the benchmark rate. So because of their size, they're able to do so. So if you are a smaller company and you want to borrow from the bank, obviously you're not as safe as Apple. So they will quote you as a benchmark rate plus a certain percentage, maybe 2%, 5%, 10%. So depend on your risk level lah. If the bank deems you as risky, then they will increase the percentage. So it's always a base rate plus a percentage. So the central bank or the Federal Reserve for the US case usually adjust the base rate or influence the short-term base rate so that they can kind of incentivize or sort of push businesses and consumers and customers into borrowing more to spend or to stimulate consumption. On the flip side, they also can influence the rate of savings. So of course, if they increase interest rates, means that if you put money with banks or you buy bonds, generally the rates will increase. So on the flip side, if central bank feel that they want to, slow down the economy or they want to incentivize people to save instead of spend, they can also increase interest rates. So it has a dual effect. So of course, if interest rates are low, putting money in the bank doesn't really give you much returns. You're more incentivized to spend. Yep, and usually the Federal Reserve act as the borrower of last resort. That means the banks, right, usually try to borrow from each other first. And so if they can't, then they will borrow, then can borrow from the Federal Reserve. That's why the bank rates are generally lower than the Federal Reserve. That's why the Federal Reserve is or the central bank generally is the borrower of last resort. So banks don't want to go there as much as possible to borrow money. Okay, so let's say for China, the central bank is called the People's Bank of China. So recently, the China Central Bank has actually kind of pledged to cut interest rates to in the amid the uncertainty of the global outlook, especially with US, doing another sanction, doing tariffs on them, be it 10%, 20%, and maybe more, with Donald Trump on the helm. Anything is possible, especially when he's dealing with China. He has been quite hard on China since his first term. Now that he's in the second term, he has been adding more tariffs. So because of that, the Bank of China has actually pledged to cut, haven't cut, but pledged to cut, which obviously will stimulate or plans to hope to stimulate the economy of the Chinese market. Then, generally, central bankers use the interest rates to influence the money supply and to stimulate or to slow down economy, especially when there were higher inflation rates during the COVID time. Actually, a lot of central banks, especially US one, has been hiking rates at a very aggressive pace to hope that, with high interest rate, they make businesses not want to expand because, the opportunity cost is very high, that, they will start to slow down their purchases and, and for our consumers, we will consume less because, the interest rates are high. You don't want to take out loans as much, but you want to be paying them off instead of taking on new one. So more stimulus tends to be more risk on. So if central banks decide to drop interest rates, generally it's a good sign for businesses and investors because like what Warren Buffett say, the gravity on stocks is lower, so asset price tend to go up. But of course, you must still see the other macroeconomic things that we're going to discuss, especially the GDP and the reason why they are dropping interest rates. If there's like a recession, obviously it's like a dual effect. So if recession is bad, but lower interest rate is good. So depends on uh, how much of the recession is expected, or be it the unemployment rate and the size of the rate cut will come into play. So this is something that you cannot just look at on a one dimension. You must see on a multiple dimension because all these macroeconomics affect the economy and they may not be always equal at the same time. So even though if two go down, one go up, doesn't mean that it's a bad thing. Yeah. So we need to explore more into the different macroeconomics. So this is also one more thing about for the safe assets. So for investors, generally, they are usually between stocks and bonds. So stocks is your risk on. When times are good, they do very well. But times are bad, they can do really bad. Then bonds is like your more safer assets because they generate a steady income. But generally, on over a long term, especially when interest rates are low, bonds tend to be, something that we buy as a hedge instead of something that generates a lot of returns. So, but then when there was the higher interest rates, then usually bond rates will go up. So people will start to shift their proportion between stocks and bonds. So at the bottom right, we can actually see that there's a chart lah. So when interest rates and inflation generally comes hand in hand. So when inflation goes down, generally the Federal Reserve will try and drop interest rates. When the inflation goes up, generally the central bank will increase interest rate to combat inflation. So interest rate is one of the biggest tools the central bank use to combat inflation. So now is a fun question for the audience lah. So does Singapore control or sets interest rates? I mean, when I talk about Singapore, obviously it's the MAS lah. Our central bank. Do they are they involved in setting interest rates? Like the SORA, do they like, report every quarter, we're gonna, or every time they meet, we're gonna increase or decrease interest rates. So of course, if you think yes, put yes in the chat. If you think no, the MAS don't set interest rates, you can put no lah. So okay, I see one person say no. Anyone else agree or disagree with him? Okay, we have people saying yes. Of course, they control interest rates. Okay, surprise, surprise. Singapore does not control interest rates. Singapore adopt a different strategy. This is just a FYI lah. Singapore actually uses what we call the foreign exchange operations. This is from the MAS website itself, so don't worry. This, their monetary policy they use is slightly different from other countries. They influence it. They don't set it, but they can influence it. Yeah, that is the correct term. So of course, what they do is the MAS will actually conduct monetary policy based on the Singapore dollar nominal effective exchange rate. So they influence the exchange rate when inflation is high. Yes. So during the COVID time, if you have observed, the Singapore dollar actually appreciated quite a bit, especially during when inflation is high in the late 2022 all the way to later part of 2023 as well. So actually the Singapore MAS usually influence the inflation by because we import most of our ingredients and like the CPI basket goods. So that's why they feel that by controlling or influencing the exchange rate, they will be able to control inflation that way better than setting interest rates. So if you don't know, there's this thing called the policy trilemma, which all central banks have to pick a certain side lah. So it's a triangle. So they only can pick two out of the three. So if you want a fixed exchange rate, then you must give up either the free capital mobility or the monetary autonomy. Then if you pick, you only can pick two out of the three lah. You can't pick all three. It's impossible. That's why it's called a dilemma or trilemma. You only can pick one side. So certain countries will pick A, B, or C lah. So yeah, Singapore case is B. Then for China is C. Yep. Then for Hong Kong, it's 8. Hong Kong has a fixed exchange rate with the US dollar. It has free capital mobility, but it does not have monetary autonomy. That means it usually has to follow the US side. Okay, now let's talk about the elephant in the room. So Trump talks about a lot of things. So one of the things he talked about is he doesn't like is the US trade deficit. You know, he sort of says that, hey, the US is always in a trade deficit, means that, US has been importing more than they export. That means they buy more stuff from other countries than other countries buy stuff from them. So this can be, calculated on a country level. That means, that's why Donald Trump always target, hey, this country A, country B, hey, we buy more of your stuff, and you don't buy enough of my stuff. Then he feels that, there are other countries taking advantage of them, or they are like, exploiting them and so on. So, we're here to investigate whether it's true, whether it's a big problem, whether it's he's just talking nonsense or what. So here we have to see lah. So first thing, U.S. has been in a trade deficit since 1976. Don't worry, we have a slide later to showcase a bit more clear. So it has been a trade deficit due to back in the day, they actually were importing a lot of oil and gas. Back in the day, US was a net importer of energy. That means they need to buy, they consume more oil or crude oil than they produce. So they have to buy from somewhere or from the open market lah. So they've been buying a lot of oil back then. And one key point to note that because of this trade deficit, they have been actually across the years, they have been having lower domestic manufacturing. That means a lot of their stuff, instead of making in-house in US, they actually has been sort of shifted out lah. So to Mexico, China, and other countries. So President Trump believes that trade deficit is other countries taking advantage of the US. Okay, so how much trade deficit is Trump talking about? So here is a nice diagram showcasing the top trading partners of US in 2024. So we can see that Mexico actually has quite a big trade deficit. That means US actually imports a lot of products from Mexico and also China. China is second for in terms of imports. Then of course the trade deficit is the difference between what they import and what they export to their country. So we can see here that for Mexico, the trade deficit is about $171 billion. Then for China, it's about 295.4 billion lah. So these two are the most obvious big numbers out there. Then we also can see that Canada, their close partner, has a negative $64.2 billion. So so to Trump, it feels that, hey, I buy a lot of your stuff, but you don't buy a lot of my things, and it's unfair. A quote from him himself, he said that they have to balance out their trade, number one. We have deficit with almost every country, fair, from the data it shows. But not everyone. Like let's say we have UK, UK actually buys more stuff from US than US buy from UK. That's why it's in a positive number. Uh, but almost and we are going to change it. So Trump wants to have some policy, right? Do some government policy to change this from a negative number to a positive number. It means they want other country to buy more from them. That's why he wants to create jobs, manufacturing jobs in US so they can create stuff for people to buy. I mean, you can't just call them up, hey, buy more of my things, buy what things, You can't just, buy something that don't exist. So that's what Trump kind of wants is that he wants to build back their manufacturing, want to get manufacturing jobs back into US so that they can create more things, other people to buy, and the trade deficit will not become so negative or maybe even become positive. So In the history, uh, so in the history, we can observe from this chart on the left, which is the manufacturing percentage in terms of GDP. That means how much of GDP comes from manufacturing. So from the US since 1997, 1998, right, it's about 16%. Means back then, every $100 of GDP, 16% comes from manufacturing. Now, current day is about a little bit above 10%. It has been declining lah. But if we observe the chart on the right, which is the same thing, manufacturing for GDP, but for the whole world, we can also see a trend that manufacturing as a percentage of global GDP has been coming down across the years because of GDP is being generated in other areas, and also manufacturing has not been too much of a focus of a lot of countries. So this is a timeline from 1895 to 2015. So we can see that throughout the history, I mean, throughout the 1895 to 2015, for the US, the trade balance has not always been negative. So between 1895 to about 1970, actually the trade balance has been positive. That means the world has been buying more from the US than US buying from the world. So we can observe that during this period, there is a high tariff rates. Then during the middle period is where post World War II, when the Bretton Woods Agreement sort of say that we want to trade with each other. So all the nations will pack or more all the some of the nations will pack their currency with the US dollar, and the US dollar will pack their currency with gold. So because of this, of course, there was like a fixed exchange rate of sorts. Then of course it didn't end very well. In 1971, if I'm not wrong, President Nixon ended the Bretton Woods Agreement. It sort of say, guys, remember that agreement we signed a couple, like about 20 years ago. Yeah, yeah, yeah. Let's not do that anymore. Let's I'm not gonna pack my currency with gold, and then we're gonna close the window for you to exchange a US dollar into gold. Then of course that sort of sets off a whole new thing about how different currencies start to depreciate or appreciate based on their status in the world economy. There's also when Japan, their currency start to, uh, if I'm not wrong, they start to appreciate their currency. So here we can observe that uh, during the low tariffs, right, the US actually incurred uh, a negative trade balance. So next. So now, the elephant in the room also is the word tariff, like what Donald Trump like describe it as the most beautiful word in the dictionary. Yes. So tariff to Donald Trump, he wants to use tariffs as a way to decrease trade deficit because, and bring manufacturing jobs back to the US. He's been selling this idea and this thing and to punish countries for taking advantage of US. It's like, you have we have a negative trade balance. How am I gonna do about it? I'm gonna tariff you. So make it so that importing from them gets more expensive because when you import something and there's a tariff on it, you have to pay a certain percentage based on the tariff. 10% means you have to pay 10%, and it's the importing company has to pay. So he also has been saying about how he wants to use the tariffs to generate the tax revenue so that he can lower tax for everyone else. So he has a lot of ideas that how he can use tariffs to solve this trade imbalance problem. And he has identified, his obviously his most neighboring countries, Canada, Mexico, and China first. Like we saw in the previous few charts, they are the top. Then he started to target other people like the EU as well. So for him, anything is in a deficit sounds like a bad thing, you know. Prefer a trade surplus. You prefer people buying more from him. But is a trade deficit really such a bad thing? You know? Just because you buy more from other people than other people buy from you, is that really such a bad thing? Economists have usually debated over it. For the case of the US, a trade deficit actually can be a sign of economic strength. You know, you can have strong consumer demand and also high purchasing power. Because US is a bit special because US dollar is so widely used over the world for trade, be it for, commercial trade, commercial borrowing, as in international debt. Even countries that have nothing to do with the US will still agree to rather have their debt in dollar denominated than their own currency or other foreign currency. So US dollar is so widely used around the world that because of this high demand for US dollar, it has a stronger value to it, stronger than what it was if it is not the dominant dominant currency that's used around the world, be it for foreign exchange and trades and so on. But because of this stronger dollar, it's much more expensive, or it makes more like make it so that any trade the importing country, like let's say I want to buy stuff from US because of their strong dollar, it kind of put them at a disadvantage. But it puts an advantage for US because they have a stronger dollar to buy other people's stuff. That's also one of the reason why economists sort of debate that actually having a trade deficit is not a bad thing because you have a stronger dollar, stronger currency, so importing is a lot cheaper lah, in a way. Yep. And for in exchange for buying more of the world, sort of make it so that other foreign countries like China, Canada, so on have to invest in the US, be it through debt, that means buying their T-bills and stuff, or to buying their goods. Yeah. So, and one more thing is to take note is that in any trade, right, both the importer and exporter benefit. So Trump sometimes have a weird kind of way of saying that, in a trade, I must win. You know, me first, I don't care, I need to win and you need to lose. But in trade, right, generally, if both sides don't win, right, they won't be a trade. Why would the guy trade with you if there's nothing to benefit from it? So usually people only trade when it's a beneficial, and that just because you buy more of other people's stuff, it's not apparently a bad thing. Because this is just the trade. There's also investments and other flow of capital that comes into play. So, has Trump done this before? Yes. In 2018, American company called Whirlpool, if you don't know, don't worry, it's a like a washing machine kind of company. They usually manufacture washing machine, dryers and stuff. Then the Whirlpool CEO kind of called Trump, say ask for help because they say that the Korean rivals like LG and Samsung, their washing machine is too cheap, because they have cheaper ingredients, or they're able to manufacture cheaper than Whirlpool, which is a US company. Then okay, Trump is like, you know what? Okay, we will help you out. Then they impose a tariff of 20% to 50%. So 20% first, then reach a certain quota, it becomes 50. So, the net tariff is about somewhere in the middle. Lah. Then because of this, Whirlpool chairman obviously is very happy. Lah. Hey, you increase the price of my competitor because when they import all these Samsung and LG washing machines, they need to pay more, so their base price become higher. Then of course, as a Whirlpool chairman, obviously you're happy lah. Your competitor suddenly cannot compete with you in price because now with the tariff they're more expensive than you. So of course you're happy. But at the cost of consumers. So from 2018 to 2023, the cost of laundry equipment rose 34%. while inflation only rose 21%. So it rose way above inflation, mainly due to the tariff, lah, of course. And consumers have, are the one who has to pay. Because guess what? The importer are not going to pay. The importer have to pay this difference, but guess what? Because it's going to push up the price by the difference. Then they will push it down to the consumer. They are not going to be the one eating, like, they're not going to set the price the same and eat the tariff and affect their bottom line. Because they're just going to be like, oh, the government tell me I have to pay more. Okay, no, I'm going to charge the customers more. So on average, the on per washing machine went up by $90. And one funny thing is, even though only washing machines got tariff, the dryer price, right, also went up because if you sell as a package, washing machine plus dryer combo, then the combo both went up. So I thought maybe they just want to take advantage of the situation as well. So here we can see, of course, during the tariffs, imports declined. I mean, of course, it costs more. Then, on top of that, a new factory was built. If I'm not wrong, it was Samsung that or one of the Korean company actually came over to US to open a new factory, which created about 2,000 jobs. Sounds great, right? That's what Trump wants, right? I tariff more jobs in the US, and we stir up the manufacturing sector in the US. Sounds good. But at what cost? But then the net annual cost to consumer for each job, right, that was created by the tariff is about $800,000. So is it worth it? Yes, he got the jobs, but it costs other consumers on average 800,000 US dollar per job for that 2,000 job. That is, to me, doesn't sound like a great deal, lah. It means, you are like technically buying the jobs at a price of $800,000 per job. It doesn't sound like a great deal. But, it depends on how you spin it. If you just don't talk about that and just talk about, hey, we created jobs, imports decline, we are growing our manufacturing in US, sure. I mean, if that's the picture you're trying to paint, then yes. But if you talk of both sides, it's quite an expensive experience lah, for both the American consumer and also the businesses as well. Okay, so tariff, first thing, tax imposed on the importing company. So when he says he want to punish Canada, punish Mexico, punish China, number one, China and Mexico is not paying for the tariff. The tariff is paid by the company in US importing. So, that's something to make it clear first. Tariffs are imposed onto the importing company. So it makes the importing company needs to pay more for foreign goods. So, China, Mexico, and Canada is not paying no tariff. It's just the importing country is paying tariffs. Next, tariff worked against the ideals of a free market. So, of course, if it's a free market where there's no trading barriers, then of course countries who are good at doing certain things will only do that thing. This is called specialization and having an advantage. So if US is good at making cars or making EVs or making financial services, then they will only do that. And then they'll import the rest from foreign countries. Because why would I do something if I'm not good at it? And it costs more, then I just import. So that's generally the case. So, and trade benefits all parties. Everyone is better off if we trade with everyone, trade each other, and we all create what we are good at or what we have a advantage at. Then tariffs tend to create more tariffs. That means, it's a tit for tat thing. Like, oh, you tariff me, I tariff you. Then you're like, oh, you tariff me again, I'm gonna tariff you. So, it's a sort of a thing where nobody gains anything from this. It's like you're making enemies. You are kind of, creating more and more tension between countries. Like, if especially US now want to tariff Canada, he's been roti prata the thing lah. One day say, oh, we're gonna tariff 25%. Next day say, you know what, let's extend it for a week or a month. Then after 1 month later, you be like, it's on the table again. And then you say, oh, you know what? We will tariff this from a broad base become a small, from everything. Oh, no, 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 we only tariff this thing. Then he's kind of sort of making people don't really know what he's doing. Then Canada also responded like, hey, if you tariff me, I'm gonna shut off your power, I'm gonna, not do this. It's your neighbor, for God's sake, you're supposed to working together. But because of this tariff war, right? Then you sort of make it until it's like not from allies become enemies. Yeah. Then tariffs, without a doubt, will increase prices and limit choices for consumers. So it's not never a good thing for consumers. As a consumer, or as American citizen, as us, we do not want tariffs at all, because tariffs means that maybe the company will not import foreign goods, then, or will not import from this country. It means all the stuff that will be imported from this country, suddenly all these choices are gone. That means we have less choice, which means that the remaining remaining goods have less competition. That means they can be more flexible in terms of increasing prices and also squeezing us, which is not good. As a consumer, I don't want that. I don't think anyone wants that. But then, usually tariff is used as a way for a negotiating chip. So some in the past they've been used as, you know what, we tariff you, but then if you do this, I will not. I will remove it. Or you remove this thing, like I want something from you, then if I remove the tariff, you do that for me, kind of thing. So it's like a politically negotiating chip. Then US under the leadership of Donald Trump so far, even his voters are like, you know what, I voted for you to reduce prices. Then suddenly you are, going a bit off the books. You're doing all these things that, doesn't look like it's reducing prices, but might even increase them lah. Because usually all these policies, like let's say you want to say tariffs and all this stuff, it takes time and it's a lagging effect before it affects the markets and the overall price. Because businesses do not make decisions day to day based on tariffs, especially unless it becomes real, and then businesses will of course think so. Unless business is doing more like a long-term plan. Let's say they want to create a plant. At first, maybe they're thinking about, hey, let's put a plant in Canada, let's sell to the US, close nearby, it should be quite cheap. Uh, but then they realize, oh no, this Donald Trump, for the next 4 years, he's the president, and who knows what he's gonna do next. So people are more hesitant into doing bigger, companies are more hesitant in doing bigger investments into, countries around US, especially when, Donald Trump is threatening tariffs left and right. And also one more thing is about the Ukraine situation when Donald Trump and his VP has been, not handling the situation very well, especially with with the Ukraine President Zelensky inside the White House. So I believe, yep. So they haven't been doing that situation very well, creating a lot of people thought that one of the reasons why Ukraine removed their nuclear weapons was because the US or NATO give their assurance, security assurance. Then when they need help, right? Then suddenly Trump is like, no, we are not doing that anymore. Then it made Europe also a bit worried lah. Don't worry, in the next few slides we will explore that as well. So next thing, in the grand scheme of things, how, like, when we talk about trade deficit, we talk about it for the past like 20 minutes. So how important is the trade deficit to the US? If we see their GDP breakdown, right, the big pie, right, is consumption. US is a generally consumption-based economy, 68.5%. So consumption is the number one thing. If you see that little line over here, somewhere here, yes, this line, right, is the net exports and goods and services, which is what the trade deficit creates. So it's about negative 2.9% trade deficit of about I think below a trillion. So it's actually, in the grand scheme of things, right, is not a lot of not a big problem. About 3%. 3% of 2.9 29 trillion is less than $1 trillion. Yep. May sound like a very big number when Donald Trump says it, but when on the grand scheme of things, yeah, it's not that big of a problem. Yeah. Okay. So looking forward. So now, currently, we have observed that there have been a rotation of the US equities, especially with Europe having this thing called the Rearm Europe initiative, where they have been spending, Europe investors and business have been investing in their own companies, especially defense, because of, kind of the treatment of how Donald Trump treated the Ukraine president and how Europe was like, oh no. Usually we rely on US, or, we rely on NATO and US for like security and defense so that we don't need to spend so much money on defense. But now that, US kind of say, hey, if it's nothing in for me, I don't want to do it. They're pulling out of agreements left and right. Then it makes US and it makes EU kind of feel like, hey, what's going on here? I thought we have this in the bag. I thought we are allies and friends, and apparently not so much. So because of this, Germany, especially Germany, the one of the leading EU countries, have had a paradigm shift where they are investing heavily into their own, even converting some of their car manufacturing factories into, instead of making cars, they are making guns. I mean, last time they did that, it didn't end well, lah. But hopefully this time it's a bit better. So on the right, we have a DAX index. DAX is basically the Germany index. It tracks, if I'm not wrong, is 40 counters, biggest counters in Germany. So we can see that for the past 6 months, it actually went up 23%, which is quite impressive, lah, considering the DAX has been underperforming for quite a long time. Then for the left side, we have this EU defense company that has just gotten a lot of money from the government to sort of expand and build and to increase their manufacturing capability of to create more bombs and guns and stuff. So for the past 1 month, they actually went up like 55%, which is quite impressive lah. And the US side, right, if you were to have a look, their defense company not doing so well, because EU usually buys from the US, then suddenly, with all this happening, they actually will want to invest into their own defense, and they have to make sure that in the event, they're not so friend with US, they are not like sort of too reliant on the US, and they want to diversify their defense. So now looking forward, first thing, the U.S. Federal Reserve on March 19 had a talk, FOMC meeting, where they gave a statement. They said quite a few points. Some people usually read the positive news. Like what Jerome Powell say, there is soft data points. That means soft data, which means that in surveys, which is soft data, lah. Hard data means that, like the numbers come out, is this number means this number. Those are hard data. Those are collected, like let's say the CPI increased. That means they have collected the data, and this is what it shows. But soft data means it's like surveys. So asking people what's their opinion, kind of thing. So they have been asking, business people, investors, what do they think is the most important risk, or what do you think about the markets? Most of them feel that tariffs are most likely going to increase inflation, increase price in the short run. But Jerome Powell also want to calm the market and say, oh, in the long run, in like 2 to 5 years, generally the results, the survey shows that people expect about the same inflation. It means inflation under control. But in short run, kind of will most likely increase. Like inflation expectation increase. Then Jerome Powell also used the word transitory, which is a bit he shouldn't be using that word anymore lah, because last time he used that word, the inflation wasn't transitory lah. So I feel that he shouldn't be using that word to spook the market a bit. Second thing, they also talked a little bit about the recession risk, about how, due to the increase in uh, tariffs and also all this, and a lot of uncertainty in the market. that there is a higher chance of recession. We talk about 25, 30%, and the recession risks that people are pricing in are getting higher as more uncertainty is there. Yeah. Then but you also mentioned that the employment data is solid at 4.1%, and you see solid job growth, and also people looking for jobs are getting it. But he also mentioned that the timing between the jobs are slightly longer than usual, but there's still a lot of high quality jobs and all. So he sort of commented that because as a Fed, you have a dual mandate of both making sure that the uh the price level is in check, means inflation is in check, and also employment. That's why he does comment on the employment and price level and inflation as well. So to them is short run maybe a bit bumpy, but by the end of the year, things should be fine. Yes, that's their view lah for now. So also another thing to take note, especially recently, Donald Trump has been sort of teasing a little bit of what they call what a Liberation Day. Yeah. It's like his grand tariff plan that's coming up on 2nd April lah, which is quite soon next week. So that's something for you to see. Uh, this situation is changing every day. So, whatever I say right now may not be true tonight because, Trump has been saying a lot of things. So, markets have been rallying due to potential tariff retreats. Trump has been saying instead of tariffing like all the products, let's tariff specific targeted ones, which I agree with is more effective because, if you just tariff everything, it kind of like shows that you just want to like sort of hurt them instead of, like, you're not sending a correct message. If you feel that some products that they are not treating your the other countries not treating US products properly, be it because they tariff US side as well, then you can have targeted tariffs kind of make more sense in my point of view as well. So Trump has been exploring instead of broad based, more targeted. So what can you do? So simple. I think as a risk management, because we always like to talk about risk first, because as investors, in times of volatility, knowing how you can manage your risk is very important, especially during times of great, market movements. So a lot of people are very emotional and so on. So especially if you are holding stocks that are very sensitive to tariffs, you might want to, consider hedging, be it through using of CFDs or using other products to sort of minimize your risk temporarily until you decide that, hey, you know what, I think it's more risk on again, then you can close your hedging position, your short positions, continue with your long-term strategy. Next, look out for more signs and data. So more signs, soft data. So because sometimes soft data tend to flash red first before the actual hard data comes in. So if more and more people are expecting high inflation, generally it's like a self-fulfilling prophecy because when people expect inflation, they kind of push up the price because they already know that they expect it. That's why inflation expectation is very sensitive, and the Fed usually generally look closely to it because if people expect inflation, then there will most likely be inflation because people are increasing price, people are because of the expectation. Next, we need to monitor the US Fed because the US Fed usually choose their word very carefully because they don't want to misspeak or use a wrong word. Uh, then we have to really focus on what he's saying and whether what they foresee lah. Because US Fed generally has the one of the most information and they're required to tell the truth lah. Yeah. But as always, uh, for me as investors, we cannot always wait for market to crash. So when the price is right, when it hits your target price, you can consider going in instead of like waiting due to the uncertainty lah. Because uncertainty has always been part of the market. It won't be gone forever. Just every day or every year is a different theme. Last year was inflation, this year is tariffs. Every year, it's different. It's just part and parcel of the market lah. So if you are a long-term investor, don't worry, it's not end of the world. Continue with your strategy. And if you really worried, do some hedging. So in conclusion, macroeconomics affect all areas of the market segment. It doesn't matter you are a small company, startup, even you're not listed, it affects you. Affects you, affects me, affects everyone. That's the whole point of macroeconomics. It affects everyone. It's the big umbrella. Then tariffs have a long history, and we explored some of the strengths and weaknesses and how Donald Trump has been going around doing it. We explored how the macroeconomic factors affect today's market. Quite a few lah. Then also Trump's trade policies and direction and how it's affecting everyone, and how we can like sort of position ourselves to it. So lastly, we have a promotion for especially for the clients or you all if you all haven't opted in for CFD and you want to try CFD to start hedging some of your positions. If you are on an IRC level, it's your first time opening a CFD account, then congratulations, you are entitled to this promotion. So simple. If you just create a CFD account and you proceed to trade your first trade, you get $100 cash credit. Then every subsequent trade will be $10, up to $50 a day. But do note, the promotion period is from now to 31st March, which is ending real soon. So do take note of the time and if you want, you have to act fast really. Okay, now we're open to the Q&A. Okay, let's have a look at the questions. Wow, we have quite a few. Not bad. Okay, let's see. Okay, I have a first question. Not really about the content, but about CFD manager himself allowed to trade own money. The answer is yes. Yes, we're allowed to trade. Obviously there are some restrictions, but yes, we're allowed to trade. Okay, next question. Is good and services counted in trade balance? Okay. Trade balance only considers import and export. That means whether you buy goods and services or stuff from other countries. So you buy Taobao, yes, that's considered import. Yes. Okay, next question. Trump must know that it will take years to set up manufacturing back in the US. It is a long process. Why he wants to do that to address trade deficit immediately? Okay. If you want to influence trade deficit immediately, setting a tariff is a immediate, I won't say immediate effect, but like as immediate as it can get really. Like I agree with you in terms of it takes years to set up manufacturing back in the US, but for people to even justify setting a plant, right, it takes years to make. You can't just make a plant in a year or two. It takes 3, 5, 10 years, like a long-term investment. So for it to make sense, he will need to set the tariff for a prolonged period of time to justify setting up the plant, which currently he kind of like dilly-dally, kind of like, roti prata, then kind of like defeating the purpose. Like, if I'm a business and you keep changing your tariffs, I won't want to start a factory there. Yeah. Because who knows? Maybe you remove tariff, then my factory that I built there no longer competitive. Then wow, thank you very much. Yeah. Next. Okay. How prevalent is false declaration like washing machine declared as dryer to evade tariff? Okay. Yes. There are loopholes. When you say false declaration, you know what? Those are one of the problems. But another legal loophole is, let's say, one very good example is, China and US not on the best terms. Okay, tariffs left and right. So what China company does is, instead of going straight to the US, what they do is they go to another country, for example, Vietnam. And then from Vietnam, the Vietnam company will take the thing, slap on a new label, and fly over to US. Then, in the eyes of the US, oh, this thing was created maybe 10% in Vietnam, 90% in China. Then they'd be like, oh, but it's an import from Vietnam. So, no tariffs. There's a lot of like ways around it that US kind of found out and try to do something about it. Especially the washing machine one. They kind of sent it to Mexico. Then Mexico sort of like put in the last bit. So it made in Mexico, even though it was like 99% made in China, and then or made from like the competitors. That's how they circumvent tariffs. Tariffs are not a foolproof way, but it's a kind of way on an international level to say, anything from this country has to pay a bit more as an importer. Yep. Next. We have employment data is fake news. Partial time sector food data counted as well. High employment will indicate low save. High employment could also indicate lower savings and lower appetite for investment. So high employment is in this sense a bad omen for. Okay, why employment data is important? Because like I said, the Federal Reserve or most central banks across the world, Singapore included, they have two mandates, two things that they care about. Only two. Number one is whether inflation is under control. Number two is whether unemployment is low or employment is high. Okay, that's the only thing. The two numbers they care about. Of course, you can tell me, employment data is doesn't really show the full picture. I agree, but in the Fed's point of view, so long these two numbers are taken care of, I am doing a good job. And I do a good job means I get to stay in my job for longer. So you get what I mean. So unless this employment data or this false employment data or not a full picture spills into other sectors that affects either the price or the GDP as well, economy and stuff, then of course they will take action. If not, then that's their job, man. They have dual mandate. Yeah. Okay, next. Well, if own the stock and facing price drop, what is point of hedge with CFD? Just sell main stock. So CFD benefit only on basis that maybe the transaction fee is lower than the transaction of main stock. Is it? That's a very good question. So as an investor, okay, we generally are bullish long term. Like it or not, you are most likely holding stocks. I mean, buy and hold. Okay. So in the short run, right? Of course, you can sell your portfolio. No problem. If you think the market is gonna crash tomorrow, you want to sell everything today, by all means. But what if you're wrong? What if the market never crash tomorrow? Then you look like an idiot. You don't look good. So sometimes when we talk about hedging, right, doesn't mean you have to hedge the whole thing. Oh, I take no risk. Bye bye. I'm out. You know, Generally, in the long term, holding stocks pay off. Holding equities pay off. We understand that. I mean, the history has shown that. And you get paid, I mean, you get rewarded for time in the market. So instead of, hey, I'm out, I'm all in cash now. The problem about selling your main portfolio is not about the sell part. Selling is easy. It's two clicks. It's about what you're gonna do afterwards with all these funds, right? What are you gonna do? Buy bonds? What are you gonna do? Put in MMF? The thing is, that's why we use CFD to hedge, right? Is to hedge maybe 50%, 30%, depends on how confident you are that market is going to crash. So when touch wood, okay, market crash, at least your 20-30% will cover lah. Yeah, will cover like at least you don't feel 100% of the drop. Yes. But if it goes up, right, your main profit is still going up, so it's okay. Okay, I think due to the time constraint, I think we have to end here. If you have any more questions, just email me lah. I don't know where it's at cfd@phillip.com.sg. Yep. Thank you very much.